Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, August 31, 2017. We're looking at a daily chart of the SPY, or SPDR, which is the proxy for the S&P 500. Well, we had another up day today, and a pretty good one at that. The SPDRs were up 0.5%. The S&P cash index up about 14 points. The other markets were up across the board. The Dow was only up 55 points, but the NASDAQ Composite was the strong horse, up almost 1% or 60 points. And we'll get into the other markets as we go along. But let's talk about what we have in front of us and what I think is going on. I mentioned the term last night, a bull trap. And that's pretty much what I think is going on. Of course, I could be wrong about the cycle, and it could actually invert, and the market could obviously go higher. Anything is possible. I just don't think that that's probable. In fact, I think it's a low probability at this point in time. However, any close above the high of August 8th at 248.91 will be back to the drawing board, and the cycle will have failed and something else is going on. But that's not the case today. We're just coming back up to at least get close to or potentially retest the old highs. I think it's a bull trap. We'll see if I'm right in the days ahead. However, I'm not expecting any downside to occur tomorrow. This is the Labor Day holiday week leading into a long weekend. And we talked about this, early on this week and maybe even into last week, that it's unlikely that we see any kind of downside activity of any meaning this week at all. Traditionally, this is the week where the market either goes sideways or floats higher, as most of Wall Street is actually on vacation. We know that the path of least resistance for the markets is higher. Did I expect the market to have 3 up days like we had this week? No, I didn't expect that to happen. However, what we learn in this business is to expect the unexpected. We always trade and invest in the market that's in front of us, not the market that we want to be, and therefore we had 3 strong up days this week and we have to take it at face value. I do want to point out something I find interesting. The 246.60 was what I was calling a line in the sand. I was not expecting the market to be able to close above that level. However, that did happen, so I'll take that off the board in a second, but let me show you what happened today. What's interesting is, and we've talked about this before, when the market has trouble, or at least is anticipating trouble, on a certain price level as resistance or support, we find a lot of the time that the market will gap above that price level. In this case, it was a resistance point, and that's the way it's able to get through important levels. And look what happened. The market gapped up this morning, and look where the low of the day. They came back to retest that level. The low of the day was 246.61, 1 penny above our important level. That's not an accident. It's not a coincidence. This is the way the market works. It respects important levels one way or the other. And as it turned out, after that gap higher this morning, it turned out to be a trend day higher in lighter volume and with not a lot of participation across Wall Street, and certainly no selling pressure in the market. The path of least resistance was higher leading into a holiday weekend. It's not uncommon for the markets to finish higher, so I wouldn't be that surprised to see the market even trade higher yet tomorrow. Think about it like this, and this may be a little esoteric, but think about this for a second. Leading into a holiday weekend, a lot of the retailers out there will have sales. You'll have a Labor Day holiday sale, and there'll be sales posted all over the place. People that are invested in the markets leading into a holiday weekend, if they see the market rise and they see their account value rise, they're more prone to spend money over the holiday weekend. It's a little bit of a psychological phenomenon that happens leading into holiday weekends more often than not. And I'm not quite sure who the guy would be that would be pulling the levers on that type of thing. And if I could ever find out who that guy is, he would be a good guy to know. But nevertheless, the market is floating up into the holiday weekend. My expectation is, at least from tomorrow's perspective, I think the market is at least flat to slightly positive on Friday. So just to reiterate, I think it's a bull trap, meaning I think this is the market's way of sucking in as many people as they can, making everybody feel as bullish as positive as possible, and therefore we shouldn't be surprised into next week, maybe not Tuesday, but certainly into next week, we shouldn't be surprised to see the rug get pulled out a little bit or the trapdoor opened on the downside just a little to get things started. If I'm wrong, then we're going to close above the highs from August 8th, and we have a failed cycle and back to the drawing board. I don't suggest that's going to happen. Looking over at the Russell 2000 or the IWM index, you can see very clearly where we went today. We talked about this last night. Right into the 50-period moving average. You had a gap at $140 even. That gap is right here, and we came up about 6 cents short of that gap today. I would expect that gap to be filled tomorrow. Something else could be meaningful. We'll see what happens, but this was, since the last low put in on the IWM, this is 10 days in a row up with one slightly down day in the middle there. But for the most part, we've been up for about 10 days. I think that's an important number. We'll see how that plays out going forward. But certainly a good showing for the IWM today, almost up 1% on the session. Looking over at the VIX tonight, we're approaching that $10 number. Today we made a low of, I'll just move this over real quick. Today we made a low of $10.34 on the VIX index. And you know what I always like to say, that markets like to come back to check in at former breakout or breakdown areas. That area happens to be right around $10 where we put in this bullish pattern and took off to the upside. If we came back in here tomorrow or Tuesday, this would be an area where you can buy the VIX expecting another move higher after the holiday has passed. Another thing I found interesting today was the transportation average. The Dow Jones transports really didn't rally with the rest of the market. I find that interesting, and the reason I find it the most interesting is because it was the transports that rolled over first. They rolled over way back on July 13th, or pardon me, July 14th, long before the other indexes rolled over with their first leg down. And here we are rallying back, and we retested the high of this red breakdown candle. We didn't quite get to the 50-period moving average, but we have been discussing the fact that there is a lot of overhead resistance in the transportation average that comes from really two breakdown candles and a pivot high. So right in here, there's a ton of overhead resistance in the transports, and you can see here that the transports today were pretty much the lone ranger not participating on the upside with the rest of the markets. I find that interesting, and we'll find out in the next few days whether that is a tell of something else to come. As you know, I'm watching all these different markets like a hawk each and every day. I do want to take a look at the NASDAQ market, and we'll use the triple Qs as the proxy. And we did have a closing high today, a closing new high. So that is something to watch out for. 3 big up days in a row like we just had is typically about it for the short term, meaning we're likely to pause here or at least pull back a little bit. However, this is something we do want to note. And while I don't use the NASDAQ market as a proxy for the entire market, mainly because it's top heavy and weighted in light of a few or in favor of a few select stocks, your Amazons, your Netflixes, your Apples, your Googles, and others, there is certainly reason to pay attention with the fact that the NASDAQ or the triple Qs closed at an all-time high. And remember, I think we looked at this recently. I'm not sure exactly what day, maybe last Friday, but remember, this was a bullish pattern. There was nothing wrong on the weekly chart, and this bullish pattern did play out to the upside. Supported by the 20-week moving average, the market pulled back, never really touched the 20-week moving average over here, and then took off to the upside this week. So it is something we want to pay attention to. I am paying attention to it. I just don't use the triple Qs or the NASDAQ as a proxy for my cycles. I use the S&P 500. Looking at another market, we'll look at the broker-dealer index, the XBD, and this is the flip side equation. This market does not look the same as the NASDAQ, and you can see here that we still are in a bearish pattern underneath the 50 and the 20 period moving average. So we've had, a down move, you can call this a down move or this down move, either way you want to look at it, and then you're going sideways. This is a bearish pattern that will generally play out to the downside. And you know what I always say, without the financials, the market cannot rally to the upside for too long, and also without the financials on the downside, the market is unlikely to break down. With the broker-dealer index, we do have a bearish pattern underneath the 20 and the 50 period moving average. Again, something that I'm paying very close attention to. Looking over at the other financial index that's important, which is the XLF, there are slightly different companies in both indexes. However, they do track one another for the most part. And you can see here it has the same look. And the reason why I'm pointing out all these different markets is because there are divergences out here. There are divergences between, for example, today in the transports and the major markets. There are divergences in the charts between the financials and the NASDAQ and other markets. So I'm paying attention to all this stuff, and I just wanted to bring it to the forefront so that you're aware of everything that I'm looking at, and so that obviously you can pay attention too. Switching over to the gold market, you could see here we had a pretty big up day in the gold market today. Now, I look at that as somewhat of a divergence. When the stock market is rallying, at the same time the gold market is rallying. Not that I like to marry the markets together. I don't. You know I don't. But traditionally, when the market was going down, and let's say one of the reasons of recent was the stock market was going down with a scare of North Korean missiles, right? That was the other day. North Korea fired a missile over northern Japan, and next scene shows the market sells off for an hour, and then it rebounds, and that's the end of it. Or actually, it sold off overnight, and then rebounded right out of the chute in the morning. So that's a point in time when people tend to flock over to gold, and gold rises on what's known as the fear trade. But however, now gold is rising today on what? What would be the reason that gold was rising today? And I'm not saying I have the answer. I'm not looking for the answer. The point is, I find it somewhat of an anomaly. Maybe it was just a garden variety retracement from the tail candle from the other day. That's certainly possible. But what I do find also interesting is overnight, gold shimmied down near the 1300 area, making a low of 1302.30. Last night, we talked about the fact that I wouldn't be surprised to see gold go down to around 1300, maybe 1297. The bottom of this green candle is 1297. My expectation is that gold would want to test the bottom portion of the breakout candle. And that's pretty much what happened overnight today. When you look at the hourly chart, late night at 2200 hours last night, gold tested a low of 1302.30 and then all of a sudden took off to the upside. We'll find out whether that's a retracement of the tail candle or we're going to make new highs once again. Silver has much of the same look. It was down overnight, and then today we rallied higher, and we're rallying towards the high made the other day. It's not the same type of candle. It's not a topping tail like we saw in the gold market. These two charts do look different, and from the look of silver, I would not be surprised to see silver trade higher. 1780 was my number. We haven't got there yet. Even slightly higher, the high of this pivot here is 17,896. I wouldn't be surprised to see silver take a run for that double top area over here. I know there are some traders out there, investors out there that like to buy or trade in the GDX or like vehicles that are the gold mining related exchange traded products. That's fine. Here's what we have here. So we had the breakout over this downsloping trend line. Once we broke over the trend line and closed above that trend line, we back tested it and then took off to the upside. Now we had a 2-day pullback, but we're now headed back to the upside. The question is, where is the real resistance point in the GDX? Well, let's look at the weekly chart, and you'll see here where I drew the trend line off this pivot top here, and this is where we broke out from the other day, and that pivot top is going to be absolutely resistant to the GDX market. 2572 We may or may not get up there. Once we get up to 25 and a quarter, 25 and a half, maybe we get all the way to 25.72, but there will be a lot of overhead resistance at that level. I said it the other day and I'll say it again. Anybody who is long any of the vehicles that track the gold mining stocks, you should be taking profit along the way and at least be trailing a stop along the way. You can try to ride it up as far as you can, but what my point is that there should be a ton of overhead resistance coming up. Just call it 25 and a quarter to 25.75. In that neighborhood, a lot of resistance to the market. Crude oil. Now, we talked about the level that was very important to crude oil at 25.55. Look where the low was overnight, 25.58, 3 pennies short of that level, and today we had a pretty big up day, up almost 2.5% in crude oil. It was actually up more later, but we got stopped and rejected at least temporarily, the 50-period moving average on the daily chart. Let me show you once again the weekly chart and what I was looking at. I was looking at the green up candle, and I said if we test the low of that green up candle, the likely story is that we will find support at the bottom of that green candle. That's precisely what happened overnight, and we started to rally. And remember, this is a bullish pattern that's developing on the weekly chart. So I won't be surprised at all to see crude oil going up into next week out of this pattern. Next week will be the 7th week from this up candle, and this is the time when you would expect the market to break out of this bullish pattern to the upside. If we close below this green candle on the week, meaning by tomorrow, Friday's close, then I think we go down to test around that $44 area we talked about yesterday. However, that's not what's happening, and it looks like this green candle is holding, and that tells me that the likely story is higher prices coming near term. Back on the daily chart, I just want to say, pretty interesting how these things work out. We see the same patterns work out over and over and over again. We see the market like to test the bottom portion of big green up candles and the top portion of big red down candles or breakdown candles. These are things that we point out in each and every market. We can point them out in stocks, we point them out in commodities, we point them out in whether it's the IWM, whether it's the S&P, NASDAQ, it doesn't matter. All the charts are the same. They all act and react the same way. You can take the names off these charts. It doesn't really matter what the name says. All the charts are the same. A chart is a chart is a chart. Going over to the bond market, we had the tail candle put in the other day. We look like we're retracing a portion of that tail candle. Whether or not we close above that tail candle is a whole different story. If we close above this tail candle from the other day, the tail candle from the 29th, then the likely story is we're going all the way up to 159. There's your 159. It's been on the chart for a while. That's where the next major area of resistance will be for the bond market if we continue trading higher. Right now, we're above this red candle high. If we close above there by tomorrow's close, the weekly close, then the likely story is we're going to head right up to 159. Not necessarily in one day or one shot, but that would be the next major area of resistance for the bond market. At 159 or slightly above 160, around 160.10, 160.11, would provide a great shorting opportunity in my humble opinion. One of the ways to short the bond market is by either shorting TLT or buying TBT, which is inverse. It's 2 times inverse the bond market. It's another exchange traded product. But here, 130, almost 131 is really the sweet spot. If you can get TLT up to 131, for example, that would be an area that I would be interested to buy TBT, which is inverse the TLT. And finally, we'll take a look at the dollar. We had a down day in the dollar today. We came up and pierced through the 20-period moving average and backed off pretty good from it. And like I said yesterday, I'm not 100% convinced that the dollar has really bottomed here, even though this is a nice tail candle from the other day. This is in a pretty strong downtrend, and I would really have the dollar going down all the way to 88 cents on the dollar based on the current downtrend. But I'm going to reserve any further comments on the dollar until I see more. I really need to see more out of the dollar. The dollar had my number this year already when it was at 97. So I really need to see more evidence that the dollar has bottomed, and I'm not convinced that the tail candle from the other day is essentially a bottom. And with that, I'm going to leave it there tonight. It's everything I wanted to discuss. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of